We are less than 1% away from all-time highs, but can we get there? A very tepid start to your morning. About 30 minutes to go until the start of cash equity trading after 2 days of gains. I'm Dani Berger. Matt Miller, he's off today. Bloomberg Open Interest starts right now. Coming up on the show, Dollar General pops on stronger guidance as deal-hungry shoppers pile in. We're going to take a deep dive on bargain-focused retailers. And AI fortunes diverge, Salesforce surges, Snowflake stumbles. We're going to look at who's winning and who's losing the AI economy. And breaking news, now just crossing the terminal. Meta planning to slash its Metaverse workforce by 30%. All right, some of the stocks to watch this morning, because as I showed you on the surface, we are flat. Dollar General, though, certainly not flat. It is surging up more than 4.5% this morning. It hiked its earnings guidance. Those pressured shoppers, they're searching for deals this holiday season. And I want to show you Meta, again, those headlines just crossing the terminal, that they're announcing plans to cut up to 30% of their staff working on their Metaverse efforts. Analysts had downgraded the stock last month on fears that its AI spending is reminiscent of the Metaverse spending in 2021 and 2022, which again didn't pay off in leading Meta to lay off 30%. So shares are up 4% on those cost cuts. Let's get more on this story. We're joined now by Bloomberg Tech co-host Ed Ludlow. Ed, the first thing that comes to mind is what does Meta even still do with the Metaverse at this point?
Well, it still does do it through the Facebook Reality Labs unit. And basically what sources are telling us is that Zuckerberg has said to the leadership of Meta, company-wide, they're aiming for 10% cuts. But the Metaverse ambition hasn't really materialized. So according to these sources at Zuck's Hawaii home in the last few weeks, they basically reviewed it and said the cuts need to be deeper in that unit. It's really interesting because we're so focused on AI right now, and it's a big move higher in the stock on this Bloomberg report, right, Dani? But I remember a time where the widening losses at Facebook Reality Labs unit was the main driver of the stock in the news cycle. And since 2021, those losses have totaled $70 billion. So that's where we understand those cuts will be felt deepest, 30% overall in the unit, far beyond what the rest of the company will experience. And it is part of, as we understand it, this budget planning for 2026, where the priority is now AI.
That's where I was going to go with this, Ed. How much of it is just AI is hoovering up all the cash possible and all the investment possible in these hyperscalers like Meta?
So we'll remember also that Meta is not a hyperscaler. Right. It doesn't sell compute capacity. But you raise an interesting point, which is the AI story for Meta is to have a lot of data center capacity, partly so that internal teams working on advertising and other core product can use AI to make it more monetizable and better. The idea of the metaverse is that Meta is pushing into hardware, virtual, augmented reality and smart glasses for consumers to interact with that AI software. The problem is that connect hasn't quite happened yet.
Well, to that point, Ed, they are still investing in their hardware to the point where they've poached Apple's top design executive.
The timing of these two stories, they're completely incongruous, right? Yes, you're completely right. Essentially, Apple's top designer is going to move to Meta. And the signal that gives is that Meta is really serious about the consumer-facing product design. This is somebody who has been very, very influential in all Apple products since the late 90s. Alan Dye, who you're showing on the screen now. So he's going to go to Meta. And what was so interesting about this Bloomberg reporting is that Apple felt important to issue a full statement from Tim Cook, who basically praises Alan Dye. And in the interim, by the way, Stephen LeMay, who's also been at Apple some time, steps up to become the most senior designer. But that's what I mean by incongruous. You have a story that Meta has gone for Apple's top design chief, because they want to push deeper into hardware, but they're also making 30% cuts to the unit that's responsible for it in this transition to the metaverse. The stock up now more than 5% in pre-market.
I was going to say, whatever it is, Ed, the market likes it. Looking forward to your show, Bloomberg Tech co-host Ed Ludlow. And staying in the realm of tech and AI, Salesforce rising this morning pre-market after the market yesterday delivered a strong revenue outlook boosted by its AI adoption. But on the flip side of things, look at what Snowflake is doing, down 8.7%. They delivered a weak outlook. Their operating margin wasn't as strong as expected. Joining us now is Bloomberg Tech co-host Caroline Hyde. It's a Bloomberg Tech takeover of the show this morning. Caroline, it's this question of, will AI be adopted and will it be profitable? And it feels like, yes, these companies do different things, but they're also telling very different stories about that.
But what I'd love to do is show the share prices over the year to date, because so far Salesforce is down 30%. And thus far, Snowflake is up 70%. So maybe there's an idea of, okay, how much had the market already priced in to the sheer growth that we're seeing over at Snowflake, and perhaps tepid growth that we're seeing at Salesforce that, yes, to some seems to be signaling that Agentforce finally is being consumed and finally might contribute to revenue. But Bloomberg Intelligence, Anurag Rana and the like, kind of saying, look, if you strip out Informatica, which is a recent purchase they made, overall revenue growth still isn't looking all that strong. And maybe you just think that in the second half of 2026, that's when you can see galvanization. That's when the AI Agentforce is really going to come to bear. That is when these new products actually hit revenue. And at the moment, we're still seeing an issue. Derek Wood over at TD Cowen, who's going to be joining our show a little bit later, has been saying, look, for many, the issue is adoption. For many, it's about getting the right data at the right place, being able to take on board these processes. And thus far, some clients have been questioning that. But it is that Salesforce is a bit at the record low valuation if you're looking at price to sales valuations. So no wonder maybe there's a bit of stability in the stock. The outlook for revenue does signal, though, that there's optimism and can get to double-digit revenue growth in the next fiscal year. Whereas Snowflake, people were worried about the operating margin. People have been saying, look, if you're going to run up 70% in terms of your overall growth in shares, you need to vindicate that. And remember, Databricks, a key privately held competitor, has been hoovering up a lot of market share as well. Can they show that they're competing? Can they show that people want the data management side of the business, the data lakes? It looks as though we are seeing real solidity there. It's just how much is, again, the AI offering really bringing to bear?
And it also goes back to something the Anthropic CEO said yesterday at the New York Times Dealbook Summit, basically saying everyone is YOLO spending. And yes, AI has promise, but people are spending too much. If Salesforce is saying, well, we got 9,500 companies signing up, and that's kind of yay for us. Shares are up 1.5%. To your point, they've fallen 28%. That still doesn't feel like enough to justify just how many dollars are being put to work.
And at least some of these companies aren't having to spend vast amounts on compute and GPUs in the same way that overall the offerings of OpenAI are. But this is the issue. Is OpenAI, are the large language model companies going to come and eat software's lunch? That is what we wanted to understand throughout this earnings season. Yesterday, of course, we heard from Okta and really the CEO there saying it's not eating our lunch yet. We can see applications working. Software, we're trying to see vindication from Mark Benioff that he can fend off this new AI at its heart competition, and he can build it for the real time. Snowflake, I mean, they got a new CEO from a company that was taking on Google with search that was deep within AI. So he's been there purely for the fact of putting AI and agents within his business model. UiPath is another one that just put its earnings out last night. We're going to have the CEO on the show a little bit later. He's been building AI agents for robots for 2 decades. Again, he's starting to show some traction, but the proof point, well, the story from yesterday we're talking about with Microsoft, and that just, yes, it hasn't been vindicated and borne out with Bloomberg reporting, but if we are questioning the real productivity gains from some of these sales, we're going to be wanting more from some of these earnings.
It just feels like this time, okay, Google got disrupted from AI. If something is like mainstays, Google search is disrupted, why would something like Salesforce be able to kind of make this transition versus, to your point, a more nimble startup that AI is really in the DNA of it?
I think for many, and there's always that meme, like, what does actually Salesforce do? But I think Salesforce is so within the interweavings of these companies that it's managed to embed itself in. The many feel that actually some analysts are saying it's too critical. It's too critical for business for people to start shunning it. They're going to want to go with Salesforce if they can offer them the right agent, the right ability to get its data. But at the moment, as we heard from reporting previously, like if you're looking at Carlyle Group that was using Salesforce, it wasn't reaping enough rewards. It wasn't seeing enough benefits. More broadly, I think it was Carlyle with Microsoft, in fact, that was coming in the information reporting. And then wondering wondering how they can cut their own spend. So I think for more, we want to see what Salesforce can really do with its AI tools and whether people are going to keep on spending as much. But I think analysts really feel that it's so integrated within business models, it's hard to strip out.
It's an interesting point. Maybe a lot of the spend now is the experimentation, and then they pull back and say the experimentation failed. So is this...
Those pilots, 95% apparently don't work, according to MIT. Are we going back to that level of anxiety?
Yes. Well, the market's certainly not there yet, but maybe we do. Caroline, thank you so much for joining us. Bloomberg Tech co-host Caroline Hyde. All right, we also got earnings from Dollar General. Those came out this morning. They reported better than expected profit. They raised their full year's earnings outlook as shoppers look for deals. Bloomberg's Emily Cohn covers the sector and joins me now. Emily, so today, Dollar General, yesterday, Dollar Tree. I mean, these discounters having really solid earnings.
Yeah, it makes you wonder, like, is there a broader consumer pullback? We hear a lot about the consumer being cautious and picky and choosy, but then we see pretty good, solid reports. And then I think, the question is this a good sign for the economy or is it not? And when you look at the earnings, what we're seeing is it's wealthier shoppers that are gaining share at these retailers. That's maybe not a sign that the consumer is strong. It's that the consumer is trading down, and that's what's boosting these retailers right now.
I was going to say, we're going to catch up with Goldman Sachs in the next block, and she talks about this idea that within Dollar General, you have people who are making over $100,000, that's one of the biggest growing segments at Dollar General. If that's the case, who is suffering on the other side? If they're taking market share, who from?
Well, it's a really good question, and it's one we're asking too. And, you see Kroger this morning cutting its guidance. And one of Dollar General's big levers here is that they have a big grocery section. That really arms the company well up against tariffs, less general merchandise that gets highly tariffed. And then perhaps they're bringing in shoppers who would have gone to Kroger, who would have gone to Whole Foods. Walmart is definitely benefiting from this as well. They're also seeing more share from wealthier shoppers. And the key question is, where are they pulling back from?
It is confusing, though, because you can kind of build any narrative depending on what company you choose. I saw Hormel Foods also had earnings this morning, too. They make Spam and Jiffy and all of that. I think Jiffy, at least Skippy, maybe, one of the peanut butter brands. And they're facing a lot of cost inflation. But at the same time, you have a company like Dollar General where, because they have groceries that are a little bit more insulated from tariffs, where exactly is inflation still coming through at the moment for consumer brands?
It's a good question, and I think it's still to come. Like, if you listen to what Walmart is saying, they're saying, our costs are still rising every day. I think we can expect a lot of these price increases to still come through in Q1. I think Q4, this is the shopping season. Retailers are doing everything they can to get shoppers in the door and shopping, but the question is, how long can that last?
Yeah, everyone I'm seeing, it's like it's our cyber event, not Cyber Monday, because it's lasting forever. Emily, thank you so much for joining. As always, that's Bloomberg's Emily Cohn. Okay, coming up on the show, more on the state of the consumer. As I mentioned, we're going to speak with Goldman retail analyst Kate McShane. Don't miss that conversation coming up after this break. Let's get to high interest, a look at what's making headlines around the world. Germany's ruling coalition under Chancellor Friedrich Merz is on the brink as nearly 20 rebel CDU lawmakers threaten to sink a key pension bill. With only 12 seat majorities, a failed vote could collapse the 7-month-old government and trigger new elections, just as the far-right AfD leads polls. The showdown hits as Germany's economy stalls and pressure for reforms mounts. Paramount Skydance is boosting its breakup fee to $5 billion in its push to acquire Warner Brothers Discovery. That's more than double its earlier offer. It's battling rival bids from Netflix and Comcast. Warner Brothers, they are reviewing second-round proposals that could decide its future within weeks. Netflix is said to have the higher bid, but Paramount argues its full company takeover avoids a costly cable network spinoff. Any deal, though, would be facing a tough regulatory scrutiny, but maybe it is less scrutiny because we are in the Trump administration. Pimco pulled off a major comeback this year. Despite spring turmoil from tariffs and a Sell America panic, the firm doubled down on 5 to 10-year treasuries and mortgages. It's a bet that's paid off. Its flagship income fund is now leading all major active bond funds funds with a 10.4% return. That's its best in a decade. Rate cuts, savvy positioning that helped push Pimco back to the top of U.S. fixed income managers. Elsewhere, discount shops are capitalizing on the strained consumer. Five Below and Dollar General both hiked their earnings forecasts as Americans hunt for deals this holiday season. I'm pleased to say, joining me now is Goldman Sachs analyst Kate McShane. She has a sell rating on Dollar Tree and buy rating on Five Below. Kate, I'd first like to start with you on that sell rating on Dollar General and what it would take for you to change it, and if you're reconsidering, just given how strong the earnings are in this narrative build of consumers trading down.
Yes, we actually just downgraded Dollar Tree to a sell rating about a month ago. Part of the reason for the sell rating was that survey work that we've seen show that the price perception and value perception at Dollar Tree is declining. Now, we are seeing that pressure across a lot of retail because, as was just mentioned in the last segment, tariffs are putting pressure on price. Prices are going up. And so retailers are seeing their price perception and value perception decline a little bit. But for Dollar Tree, we've seen the biggest decline. And that was really the crux of our sell call. There's no question that they reported a good quarter yesterday. Their comps were up 4.2%. But I think the issue is with regards to the comp, and what investors are trying to figure out is that same-store sales number was driven all by ticket, so by price. So that 4.2% was driven by 4.5% ticket, and traffic was down 0.3%. I think investors are a little concerned about what traffic will mean for Dollar Tree as they continue to increase their price and go towards their multi-price strategy, which is going beyond their $1.25 price point and introducing more $3, $5, and $7 price points.
Kate, one of the things I was really interested in, by some of your research, you point out that Dollar Tree, 60% of the shoppers are coming from households earning over $100,000 over the quarter. How much of that is about them versus more generally? I mean, we're looking at Dollar General. They're speaking right now saying that spending habits show that core consumer is pressured. They saw more shoppers from higher income homes. How much of what we're seeing in these results is indeed trading down versus existing customers still spending?
Yes. So I do think, with Dollar Tree, Dollar General, with Walmart, they have seen the biggest growth come from these higher income cohorts. And it is some dimension, I think, of trading down and looking for value. I think since we've been in this period of inflation, whether it be just post-COVID or after tariffs, that the customer does feel their wallet stretched, even at the higher income demographic, and they're looking for more value. So I do think that it is a testament to how shoppers are shopping and the fact that they are looking for value. But at the same time, as we go into 2026, this middle income demographic is going to be getting some form of stimulus with the tax cuts that are coming down the pike. And we do question if there will be the need to trade down, or if there will be this feeling of looking for as much value if you have some kind of tax cut for that middle income consumer in 2026.
I was going to say, how much of that trading down is sticky, that once people get used to going to these dollar stores that they stay there?
I don't know if I have a good quantifiable metric for that. I mean, I do think that the more value and the more convenience that you're offering as a retailer, the stickier the customer is going to be. I think where we've seen the biggest share gains and the most sustainable, consistent share gains has been in Walmart, and that has exclusively been because of their value and their convenience.
Kate, I mean, with this, you can get kind of a muddled picture that you have Walmart doing well, you have Lowe's, Home Depot not doing well. Maybe that's some of the pain coming from the housing sector. There have been some retailers who've done just fine, though. They've changed their brands. Places like American Eagle, for example, their earnings were pretty good. Well, actually, they were very good. Kate, when you take all these together, sentiment surveys have been bad. Some of the retail spending has been okay. What is the picture you come away with the consumer right now?
It is a very muddied picture, and I do feel like it's very noisy with all of the different data points and thoughts out there. But I think at the end of the day, the consumer is still holding in there. We have a proprietary discretionary cash flow here at Goldman Sachs that looks at the health of the cash flow for the consumer. And as, again, we look into 26 and our estimates for 25 too, you have seen, 3 to 4% growth in discretionary cash flow. That is, your disposable income after your expenses, where you can spend on discretionary goods. And it's been healthy. And so I think, the dichotomy is, and the differences are just how people are shopping, where people are shopping. Again, I think there is a lot of headlines out there that make people maybe a little bit more cautious, maybe want to be more careful with how they're spending, and that's why they're looking for more value.
Hey, Kate, a great way to put it in a note we're going to have to end on. Thank you so much for joining us, Kate McShane from Goldman Sachs. Let's get another check on Meta this morning because its shares have been surging since breaking headlines about 20 minutes ago. A small correction to issue on this, so they are up 6%. They're going to be planning to cut their Metaverse budget by up to 30%. We earlier said it was Metaverse staff. It is not staff. It is their budget. 30% of that they will be cutting, so a third of the Metaverse budget will be slashed. The move, though, could include layoffs as early as January, leading everybody to ask, are they going to change their name again? How are you going to be called Meta when you cut your Metaverse budget by 30%? Anyway, coming up, New York Life Investments' Laura Goodwin thinks AI will continue to dominate the market narrative. That's despite a recent broadening out in breadth. That conversation coming up. You're watching Bloomberg Open Interest. Futures at the highs of the pre-market session just 5 minutes ago into the start of cash equity trading. Thanks to Meta. Meta shares surging this morning after a plan coming out from them to reduce their budget for the Metaverse by 30%. That's helping to lift NASDAQ futures and S&P 500 futures up by 0.2%. At the close yesterday, we were about 1% away from all-time highs. So can we get anything closer to that this morning? A quick move through some of the movers on our radar this morning. Kroger lowering the top end of its full-year sales forecast. Those shares down 2.8%. Also some pain for Costco. Their reported total comparable sales for November missed analyst estimates. There was a notable slowdown in U.S. traffic. Those shares down 1.5%. Meanwhile, robotic stocks in all directions, they were surging, though yesterday there was a report that U.S. Commerce Secretary Howard Lutnick has been meeting with CEOs in the industry to accelerate the sector's development. Coming up, it's your opening bell. Just moments away from the start of your cash equity trading session, you are watching Bloomberg Open Interest. I'm Dani Berger. Matt Miller is out today. At the highs of the session, thanks to some rallying we're seeing in tech stocks, with Meta changing some of their spending plans around the Metaverse, up 0.2 for the S&P. NASDAQ similarly up 0.2. Russell 2000 still under pressure, with bond yields lifting higher this morning, with better than expected jobless claims missing to the right direction, and that's helping overall equities. Some of the things we're looking at today, okay, it looks like we have a SPAC down at the New York Stock Exchange. American Acquisition, an IPO. They look very happy and shaking each other's hands, so yay, good for them. Over here, because it is a giving week and it was Giving Tuesday, we have the Save HIV funding. I wish you could see it all the way over on this side. There's like a wonderful drag queen who is also attended, but for some reason they're zooming in and we're missing the beauty that is that person. Okay, some of the stocks we're watching, I mentioned this because it's helping to lift overall markets today. Here at the open, you're looking at Meta Platforms surging 5.5%. They are going to be cutting 30% of their Metaverse budget. Analysts have been downgrading the stock last month because of fears that its AI spending would be reminiscent of Metaverse spending in 2021 and 2022. That did not pay off. So are they learning the lesson from that, at least with the Metaverse, and backing off and fueling everything into AI? So that's tech. The other thing we're watching are retailers and consumers, specifically Dollar General. Look at these shares up just under 10%. They're one of the retailers that have been hiking guidance as pressured shoppers trade down and are searching for deals this holiday season. This overall equity market, though, is just 1% away from all-time highs. And I want to look at what has been leading that, because it hasn't really been earnings. If you look at this chart, it has been rate cut expectation. So I believe it is that white line there. Yes, it is the white line. That is rate cut odds for this market nearing 100% at 91%. And you can see when those ticked up, you also saw S&P 500 futures move higher too over the past 2 weeks. Let's now bring in Counsel on Foreign Relations Senior Fellow and former Bridgewater Chief Investment Strategist, Rebecca Patterson. Rebecca, wonderful to see you this morning.
Great to be here.
That is interesting to me because it is a market that has really rallied, but it's only rallying on a December cut. Can you really take that and extrapolate it forward that we're going to get more rates cuts to come and it's great and rainbows and butterflies for this market?
I mean, I would love that, but I don't think you can. I think that when we get into next year, we have a lot that's going to decide the Fed outlook, even just in the first 6 to 8 weeks of the year. So will Stephen Myron continue to be a governor? That'll happen in January. We'll get the new Fed chair named in January, in theory, unless President Trump decides to do it sooner. We're going to have the Supreme Court decision on for-cause removals of governors in January or February. And then, of course, we have the reconfirmations of the sitting Fed presidents in February. So those 2 months are going to tell us a lot about what the Fed can or will do over the whole year. But taking that aside as an important catalyst, if you look at the labor data, the inflation data, this cut's priced in. It's happening. John Williams has signaled it. But going forward, we have 4 cuts priced in between now and the end of next year. Inflation has been above target for more than 4 years. The labor market data is softening, but it's mixed, right? You just mentioned jobless claims today. The service sector sentiment index, which came out earlier this week, wasn't showing a lot of weakness in jobs there. So I think the Fed's going to have to tread carefully that they don't overstimulate an already strong overall economy.
Well, you highlight this important tension that the economic data could show that they can't keep cutting, but you could have a composition that would keep cutting. Let's say you do get the scenario where you get a Kevin Hassett Fed chair, where Jay Powell is no longer on the Fed, he steps down, you have Stephen Myron continue. Will the Fed continue to cut? Is that a composition that, should the data say it, that they'll halt their rate cuts?
I mean, it's not guaranteed, for sure, right? It's a democracy on the Fed. The chair has an outsized voice, but at the end of the day, everyone on the FOMC gets a vote. So it's not guaranteed, but I do think the odds will increase if Hassett is chair, if Powell steps down and is replaced by another Trump appointee. The odds will rise. The market will perceive that more cuts are likely. And I think that'll lead us to a couple things. I think we'll have a steeper yield curve at the margin, good for banks. I think we'll have a weaker dollar. I think we'll have higher inflation expectations. But it's not all, as you put earlier, what did you say, sunshine and roses?
Something like that.
Right, because if you have that weaker dollar and higher inflation expectations, that's going to make this whole affordability crisis that we're talking about more and more worse, not better. Mortgage rates go up, auto loan costs go up. So rate cuts might be good for the stock market in the short term, but for the economy over the medium or longer term, it's not great. And Fed credibility at risk is definitely not great.
It's incredible just how much it feels like the market is ignoring that. Maybe bonds are. And this is an argument that Greg Peters of PGIM made on Bloomberg TV earlier this morning that's gained a lot of traction. That if you look at the bond market response, it's seen 10-year yields 11 basis points move higher over the past 5 days. That it is indicating that it is nervous about Fed independence. So is there a real disconnect between bonds and equities? And if you are adding on to risk, is that a mistake at this moment? Might it soon catch up and play into that narrative?
I mean, when we look into next year, the optimists would point to lots of buybacks. So the supply of stocks is limited. That's good for the market. AI CapEx, if they continue as they say they will, that's obviously good for the market. The high-end consumer still has jobs, still spending. That's good for corporate revenues. And then, of course, the big tax refund that's due next spring to the lower middle-income consumer, which will give you, it's tactical, it's a one-off, but you should get a pop in growth. So there's reasons for this optimism to carry through next year. But, I wrote about this in the New York Times about 2 weeks ago. The economy is on thinner and thinner supports, if you will, right? It's basically AI. It's AI driving the CapEx. It's AI driving the equities that's supporting the high-end consumer. If you have a disappointment there, or a disappointment with the Fed, or some new catalyst that pulls down equities or confidence, it doesn't take much for the Jenga tower to fall.
Yeah, and on that point, some of the ADP numbers we got yesterday, it was really small businesses that were suffering. The large businesses, 500 employees more, they were fine. They continued to hire. It was those that are kind of in that 80 below range.
Yeah.
At what point does that start to show up in a consumer that really pulls back on spending? Because at the moment, it feels like it's trading down. And if you have a good strategy, if you're American Eagle and hire Sydney Sweeney, you can do well. At what point does it start to demonstrate real weakness that, especially for staples, for discretionary stocks, makes that a hard sector to pile into.
Yeah, I mean, I don't think people really appreciate the importance of the small business in America, right? It's almost half of all employees, but for trade, it is 1/3 of total trade value, and it is 97% of all importing companies in America are small businesses. So the tariffs have really taken a toll on these companies. They are cutting their sales forecast much more than large company peers. They're cutting staff, as we saw in ADP, much more than large company peers. And again, it just means that if we're taking this support from the economy out, more and more relies on, frankly, 10 companies for the entire country. It might be fine, but it becomes riskier when you have more idiosyncratic risk around a handful of companies that are keeping the whole thing afloat.
It's so true, especially when you get reporting, like last month there was reporting from the New York Times that Amazon wants to eventually lay off 500,000 of its workers for robotics. Hey, Rebecca, before we let you go, I'd be remiss if I didn't ask about crypto, just because you are an expert in this. You've led industry research on crypto for so long. It has been such a ride. Yeah. I mean, going from above 100,000 to having an 80,000 handle, now back, I think we're at 92,000 so far this morning. What do you make of not just the volatility, but its spillover effects into risk assets as a whole?
You know, I think when I reflect on this year with crypto, I have two big takeaways. One is this is still a speculative asset. When people talk about it being a storehold of value or a diversifier, it may become that over time, but it's not that yet. So if you're going to buy it, you need to understand what you're buying it and how it's going to affect your portfolio. That's one takeaway. This is not your inflation hedge. This is not your dollar hedge. The second point I'd make is the contagion risk. So when Sam Bankman-Fried's efforts exploded, there wasn't much contagion because it was a pretty contained ecosystem. That's changing. And I think MicroStrategy is sort of the tip of the iceberg of that. January 15th, I believe, is when MSCI is going to decide if they stay in the index or not. Now, that is contagion, right? That's part of what pulled crypto down, Bitcoin down so much in the recent month or so. If they stay in MSCI, they continue to get passive investor capital. If they're taken out, they lose that support. Some of this is already discounted in the market, but it could bring you another leg of Bitcoin downside. To me, that's the thing to watch. How much are traditional financial firms getting involved and public market companies getting involved with crypto? The bigger crypto gets and the bigger this inclusion, the bigger the contagion risk that we just need to be aware of.
Rebecca, we're out of time, not enough time with you. Please come back again soon.
Thanks.
It's a year that's felt like a decade, and we're so lucky to have you with us to try to make sense of it. Rebecca Patterson, thank you so much. All right, let's get a check on markets this morning because they are moving higher. The breadth, not too bad. I mean, 285 up, 214 down, not exactly what you'd want to see, but we are moving to the upside this morning. What is leading us there? It is NVIDIA, just because of its overall weight, leading this index by more than 9 points. Reports that Jensen Huang will be meeting with Trump, is in D.C., and to discuss various policies, so good for them. Meta, that's also one of the biggest gainers, cutting 30% of its Metaverse budget. Shares are up 4.3%. You have some of the other biggest stocks gaining: Tesla, JP Morgan, Microsoft. To the downside, Amazon, Apple, Alphabet. Costco is up here. They had sales a little bit tepid for their November sales. We're going to get full earnings from them on the 11th of this month. Those shares are down 2.6%. Let's look at some of the sectors. Because of Meta, because of those budget cuts, you are seeing communications up there 0.5%, and that's what's in that. Financials up 0.5% too. Overall, again, this is an equity index that is higher by about 0.2%, away from all-time highs by just under 1%. Coming up, Alphabet bulls are growing louder as belief in the company's TPU chips are gaining momentum. We're going to take a look next. This is Bloomberg Open Interest. As the S&P turns negative, let's get you some top calls this morning. The analyst action we're focusing in on. First up, JP Morgan, they upgrade Toll Brothers saying that the builder's strong margins make its valuation appealing, even as the firm stays cautious on home builders for 2026. They're higher by 0.4%. Next up, JP Morgan is upgrading the restaurant technology company Toast thanks to what it calls standout software-led growth. Those shares up 1.1%. Meanwhile, fintech company Fiserv and PayPal, those both get a cut. Analysts there saying that the opts to watch from the sidelines, stay on the sidelines rather, until results start to firm up. PayPal down 0.8%. Finally, Wall Street, they are praising a stronger outlook from Salesforce, Barclays, RBC, Morgan Stanley, JP Morgan, all of them emphasizing healthier growth, improving sales momentum, rising customer appetite for AI products. Barclays calls the report healthy, so Salesforce has lost a lot of its steam this morning, up just 0.2% after a very, very bad year. I think it's lost like a quarter of its value so far this year. By the way, another AI story that we're watching this morning and that we have been watching for weeks, for months, it's Alphabet, because investors are growing increasingly confident that the company's semiconductors could represent significant growth drivers for the Google's parent. Look at what the stock has done. After slumping for a lot of this year, it continues to rise. It's up now nearly 70% on the year. Joining us now is Bloomberg Tech reporter Ryan Vlastelica. Ryan, okay, so you have TPUs and GPUs, the fight between them. If Google were to be serious about selling this technology from them, just how much of a boon would it be for Alphabet?
Hey, good morning. Thanks for having me. So I talked to some experts and analysts here, and they consider this to be an extremely significant potential business for Alphabet. One person I spoke to said this could potentially be worth $900 billion over the coming years if Alphabet were to get serious about selling its chips in the same way that an NVIDIA or an AMD does. Now, obviously, this would be a big undertaking for them. You'd have a lot of manufacturing and distribution sort of issues you'd have to work out. But there is so much demand for these AI chips that if they were able to take a meaningful part of the market away from NVIDIA, that would be a huge revenue boost for the company.
There still is this question, though, Ryan, of what is the model that works out? Is it the big spending and your ability to get these advanced chips and advanced LLMs? Or is it what we've seen out of China, small, cheap models? Is there a clear path to which is kind of winning the race?
Well, Alphabet just did come out with its latest Gemini model, which seemed like it got very strong reviews in terms of its ability to meet all these various AI benchmarks. So there's a lot of optimism about its place in the market right now. I have seen a lot of people talking about these more nimble, smaller AI models, which are less compute intensive. There seems like there's a lot of optimism around there. But if you're talking about the major LLMs right now, it does seem like Alphabet is sort of in the pole position with Anthropic and OpenAI also having their own models. But it does seem like people really feel like the stars are aligning for Alphabet.
Isn't that bad news for all the other LLMs, specifically because of the health of the balance sheet of Alphabet, that they could continue to run an LLM, not have anyone pay for it, while everyone else bleeds red trying to catch up, and then you get this world where you have a monopoly from Alphabet, from Gemini, and then they raise prices. Could that not kind of be the direction that we're headed?
Well, certainly it does seem like if you look at all the different elements of AI, Alphabet is in a very strong position in all of them. Its LLM is considered to be very strong. It has this chip business, which it's using mostly for its internal cloud right now. But like we were talking about, if they start selling this around to other companies, that's another potential driver for them. They also have a whole lot of AI data and talent and distribution. They have companies like Waymo and YouTube, which are different ways that you can monetize like AI technology overall. And like you said, they are very profitable. They have a lot of cash. They have a lot of cash flow, which does mean that they can run these very expensive LLMs in a way that isn't detrimental to their financial profile, whereas you have growing concern about something like OpenAI, where every query and every user does result in cash burn. And there is increasing concern about OpenAI's financial profile, especially relative to Alphabet.
Ryan, this conversation is far from over. Thank you for joining us. Bloomberg's Ryan Vlastelica. Coming up, we turn to media. Paramount hikes its breakup fee for Warner Brothers Discovery, a sign that it is confident that its deal can pass regulatory hurdles. That's coming up next. This is Bloomberg Open Interest. Welcome back to Bloomberg Open Interest. We couldn't make it a day 3. We still have the whole trading day to go, so maybe we will. But after 2 days of consecutive gains, we are flat to a bit down. NASDAQ 100, that underperforms, down 0.3%, as is the Russell 2000. Probably the reason for that is what's going on over here. Bonds, yields on the 10-year yield up 2.5 basis points. No thanks to the weekly jobless claims. That was better than expected. So is the Fed really going to be able to cut beyond December? It's a market that's rallied off the back of those hopes. We were talking to Rebecca Patterson earlier from the Council of Foreign Relations, who said we might not be getting those cuts. We might be looking at a re-acceleration in 2026. Some of the earnings, NVIDIA doing really well today. That's not earnings. I'll get to the earnings in a second. NVIDIA doing really well. Jensen Huang making his way to Washington, D.C. Meta, that also doing well, cutting 30% of its Metaverse budget after it didn't go so well. Are they going to repeat that with AI? Dollar General, okay, this is the earnings I promised you. Those shares up 7.5%. Some really strong results of people trading Dow. Five Below, unable to hold on to any gains, even though we've seen kind of the same thing from them. Then there's Paramount, Skydance, and Warner Brothers Discovery. Both are trading lower this morning. Warner Brothers down 2%, Skydance also down 2%, with Paramount raising its breakup fee to $5 billion in its bid for the company. That in itself is a sign that it can clear regulatory hurdles. That's also happening with recent reports that Netflix is the lead bidder for the company. Bloomberg Intelligence analyst Kevin Neer joins us now with the latest. Kevin, let's start with this idea that Netflix is in the lead. And you saw shares turn negative as soon as that report came out. It feels like no one really wants Netflix to buy this company.
Yeah, absolutely, Dani. I think that you outlined it correctly. I mean, the Warner Brothers Discovery M&A saga just continues to dominate the broader media ecosystem. And as far as who's in the lead, we continue to see these little inklings dribbling out. We're hearing now that Netflix is upping its bid to 85% cash. But I think that now the concern is this price getting too high? I mean, David Zaslav says he all along always wanted a bidding war, of course, good for his shareholders. But now the question is, where will the financing come from? And is, the price just getting too high?
Okay, well, what's better then for Warner Brothers Discovery? Cold hard cash of Netflix being like, hey, we have the most attractive bid, versus a Paramount that's like, well, we won't need to break you up. Maybe the regulatory hurdles are a little bit more easy with us. Is that enough to convince them to come over to Paramount despite the maybe higher price tag that they could get from Netflix?
Yeah, it's a great question. I think that's exactly what they're trying to mull right now at the board level. With the antitrust concerns, as you bring up, I mean, with all of these 3 reported bidders, there's overlapping businesses, right? So it's not a clear cut, flying through by any means. But to your point, we do think that, and our antitrust litigation analysts have written about this, we do think that Paramount is the best case from an antitrust perspective, and that's largely due to just the management team's relationship with the administration, right? So in terms of the antitrust, we do think that Paramount has a little bit more of an edge there, whereas Netflix, given that they're going after the studio and the streaming assets, just the size of how big Netflix is globally, HBO Max is now very scaled up globally as well, that could potentially cause some hurdles, not just in America, but elsewhere as well.
It'd be super interesting to see if Netflix would start to put movies in theaters. And just on that note, you have some really good research out with your view into 2026, what the box office is going to look like. It's been so chronically under pre-pandemic levels. Will we get anything close to back to it?
Yeah, unfortunately, it's seeming like it's just still a little bit more stop and start. On the supply side for the box office, it does look like it's going to be better next year. We have Amazon MGM, who are releasing their full slate, if you will, of movies, going from 4 to 9 or so. And so from the supply side, it does look good, but now we're concerned about demand, right? And we're looking at pre-sale tracking for Avatar: Fire and Ash that's coming up at the end of the month. That is a little bit softer than we anticipated. So maybe consumers are allocating their budgets a little bit differently with holiday shopping coming up. We don't know, right? So it's going to depend on the health of the economy. There are some big movies coming up next year.
Are any of them not sequels? Are any of them new movies?
It's a very IP-heavy slate. I will say we're seeing a rebound in animation, which we think is a positive. But ultimately, we would like to see maybe a little bit more of a mix in original titles and different sizes of budgets. Because ultimately, going back to the theaters, which you've seen a lot of pressure on that, taking it back to this whole Warner Brothers question. For the theaters especially, you want to see a little bit more of a spread out box office, so you don't have as much pressure on the profit line.
All right, Kevin, thank you so much for that, and great research as always. As Kevin Neer of Bloomberg Intelligence. Coming up on the second hour of Bloomberg Open Interest, Goodwin talks market sentiment heading into the new year. Seder. We'll also speak with Bot Auto CEO, with the White House reportedly pushing to support the robotics industry. Plus, Cayla Seder of State Street discusses Wall Street doubts around Kevin Hassett as the next Fed chair. You're watching Bloomberg. "30 minutes into your trading day, unable to hold on to any gains as yields move higher this morning." Welcome to Bloomberg Open Interest. I'm Dani Berger. Matt Miller is off today. Coming up on the show, Fed uncertainty grows. Questions swirl over whether Kevin Hassett could actually deliver Trump's rapid rate cut wish list. And will Bessent grab a bigger portfolio in the West Wing? The value pitch, Dollar General gives stronger guidance as deal-hungry shoppers pile in. And robotics having a moment in the moonshot moments. We're going to be talking to Bot Auto CEO on what's next for driverless trucking. We begin with the AI financing race. Sources telling Bloomberg that Morgan Stanley is considering offloading some of its data center exposure via an SRT. Joining us now is Bloomberg Credit Markets reporter Esteban Duarte. Esteban, a great story. First of all, what does this form look like? An SRT, how does that function, and what exactly does it mean for Morgan Stanley and their AI exposure?
So an SRT is basically an instrument that banks use to insure or to hedge the credit exposure on their loan portfolios. So in the case of Morgan Stanley, what we report is that they held preliminary discussions about potential SRT linked to data center risk or data center loans. And basically, when you carry out these kind of transactions, you are increasing your dry powder to provide new loans, either in data centers or in other parts of the credit markets.
Esteban, though, they are offloading risk at the end of the day, right? If something were to go wrong with this, those that are holding the SRT get to experience, or not get to, it's obviously not a privilege, but they feel those losses first. So is there some element of just hedging AI exposure within this?
Yeah, so basically, yes. I mean, first of all, these investors are obviously institutional investors. So in principle, you can assume that they do, very detailed credit work. And definitely, if the loan portfolios, not only in this case, but in general in any SRT, turns to be, bad, the SRT investors tend to, basically take losses, and that's and basically that risk is being compensated by a higher than average coupon. So meaning that the type of yields that you get in the SRT markets tend to be higher than in the public markets.
Okay, Esteban, thank you very much for bringing us that reporting. Esteban Duarte. Let's continue the conversation. Joining us now is Laura Goodwin, New York Life Investments economist and chief market strategist. Lauren, there's kind of two sides to this. For one, people want AI exposure, so maybe they'd buy a product like this from Morgan Stanley. On the other side, you have a firm like Morgan Stanley and all these lenders who are becoming increasingly exposed to AI. At what point is this a market that's just too bulled up and needs to look for ways to hedge some of the AI risk that it's taking?
The answer to your question is, in some ways, we're already there. But in the core ways related to risk preference, I think we have at least another year on this trade. So taking a half step back and talking about the setup for AI next year, we have an economic backdrop that's likely to be quite good growth, a slowing or a more dovish Fed, a good earnings backdrop. And on top of that, an AI trade where we see undersupply as being much more of a problem than oversupply. And so it's very likely, in my view, that leverage and exposure to this trade is likely to build over the course of 2026. But we are not yet seeing the over-leverage or oversupply constraints that we would expect would be really challenging for AI. And so when it comes to an overall portfolio, we are deploying new capital in different parts of the market, but we're not reducing a market neutral weight to these large companies.
Well, what are those other parts of the market?
A couple of areas where we're focused. We like in a likely re-accelerating, at least in H1 economy, we like financials. We've had an underweight to small caps that we're closing to be a neutral position. And we like to look at the broadening of the AI trade into energy materials. We also like commodities and gold as a balancing of some of the geopolitical dynamics. None of these are new ideas. It's basically just broad diversification. But for the last couple of years, and really last 15 years, diversification hasn't worked. Quality hasn't worked. And we think 2026 is a year where that becomes much more important.
I love this. I was reading this in your outlook because the lack of diversification had been okay in a zero interest rate environment. How far away are we from rebalancing to that? How much further do we have to go for investors to wake up and be like, okay, this time around we need quality and we need diversification?
So a really interesting wrinkle in this story is that I suggested in 2021, 2022, as inflation was picking up, the Fed was looking like they'd be hiking rates, that time was coming, that the 10 years of growth, tech-heavy outperformance, U.S. outperformance could be turning a corner. And ChatGPT and the broader AI boom has completely nullified that idea. And so your question is essentially, okay, now that we're 3 or 4 years down the road, when does that come back? I anticipate that the market's going to take steps in that direction this year, and it has less to do with the fundamentals of the AI trade and whether that's still a good idea, and more to do just with valuations. The higher the market climbs, the more challenging it becomes for the average investor to stomach these valuations. But one thing I would say is if you expect 10, 12, 14% earnings, which is what the street consensus is for earnings growth next year, you could have valuations, or multiples rather, actually stay pretty reasonable. And so again, our diversification approach is about bringing kind of a neutral stance to the market, certainly not underweight.
Well, because there does feel like this dichotomy of earnings have been incredibly strong in a multitude of different sectors. At the same time, you're looking at a jobs picture. It's not clear because the data isn't great, but some of the indications aren't wonderful. Sure, jobless claims today were better than expected, but you have ADP figures talking about layoffs in small businesses. You have Meta headlines about reducing budgets and therefore workforces in different parts of their economy. At what point do some of the labor weaknesses or wobbles, let's say, translate back into earnings? Or can earnings kind of continue at speed if we do continue just to have a low fire, low hire type labor market?
I think for the foreseeable future, this low fire labor market is actually a constructive thing for the market. And the reason I say that, there's actually two reasons. One is that we are in a sticky inflation environment. And so a labor market that, unemployment's still relatively healthy, labor market that's weakening on the edges allows that Fed dovish backdrop to persist. And it also allows the Fed to navigate new personnel, a new chair, et cetera, with a backdrop that's just ambiguous enough on the labor market backdrop where an additional couple of rate cuts is not going to signal alarm bells. That is very supportive for risk assets in 2026. The other element of that, though, which I think comes later down the line, probably not even a 2026 challenge, is that we do have, as everyone's discussing, a K-shaped economy that influences the way people vote, the way they engage civically. And what that really comes down to for the market is that it puts pressure on the government to spend. That's the real tension that we see impacting the curve and rate structure in 2026. And it doesn't feel super direct, but that is very much a part of the Fed story.
It has been so present, right? This administration focusing in on affordability, especially after the elections we just had, and the fact that we're going to get midterm elections in November. What does that look like? Is this an economy that's going to be run really hot, that's going to get a lot of stimulus, and maybe see some reacceleration?
That's our view. In fact, when I think about the 4 pillars of our view in 2026, the one that really dominates all of them is that at the end of the day, it's an election year. And it's an election year where that focus on affordability and the consumer is so prominent. So the bumps in the night that folks are talking about, the bumps that we couldn't really see, those would be likely to be met by further fiscal support. Now, without those bumps, I'm cautious. I don't think that we'll see incremental support over the benefits that we're likely to see in H1 as a result of the One Big Beautiful Bill Act. So those tax benefits, those are coming. That's reaccelerating growth just on the face of it. More than that, I think is unlikely because of the concerns that the bond vigilantes, the curve steepening, in that case, a bear steepener, really concerns about inflation would be back in the story.
Are you saying that those are back in the story and therefore pressure the White House? Is that kind of the mechanism that you're looking at?
Actually, the reverse. I think that unless there was enormous pressure on the White House and Congress to support again, not our base case, but support a flagging economy, then we probably wouldn't see incremental stimulus. There's more and more voices out of Congress saying, oof, we're a little worried about government spending. I think that's appropriate. And we've just had a circumstance where government stimulus contributed to actually more unaffordability, more inflation in the economy, which is exactly what they're trying to avoid. And so unless we see a major risk, I don't think we'll see that extra.
But the scenario you're describing where you get still sort of this muddied picture, and that muddied picture means that if the Fed is cutting, no one is freaking out. Does it change if the way the Fed is cutting is because you have a Kevin Hassett Fed chair, you have Jerome Powell step down, and you still have Myron? If cutting is happening because there are questions of independence and there's fears that they're doing it because the president wants to, is it a market that's still sanguine?
What the market is telling me right now is that a couple of more cuts over the course of this transition will probably be okay because of that muddy picture. We're not going to be able to tell if cuts are because the data is weakening and we care about the labor market and we care about the unaffordability of the economy for the average consumer, or because of political dynamics. I think one of the really important things for investors to remember when it comes to the Fed is that there are already dynamics in sort of our tolerance of inflation that hasn't gone anywhere for a year. Inflation that's already at 3%. The market's tolerating interest rate cuts with this Fed right now. And so that labor market dynamic, that muddied picture that you're describing, I think is just enough to make those Fed independence fears move a bit lower. Now, if we see in my global travels, one of the number one risks that investors cite to me is Lisa Cook being fired as an example. One of the clearer, let's say, political dynamics of the Fed. I do think that those are market risks. They're not our base case.
Lauren, you're one of the best. This has been so fantastic. Thank you so much for joining this morning. That is Lauren Goodwin of New York Life Investments. All right, a check on markets this morning because we are still negative, down just by about 0.1%. The Nasdaq underperforms, down by a third. Hampering any ability to rally this morning is what's happening in yields. They're up 3 basis points for your 10-year after we got jobless claims for the week that were better than expected, despite the fact you had challenger job layoffs that were higher, despite the fact you had ADP figures last week that weren't good. As Lauren was describing, it is not necessarily a clear picture, and maybe that allows the Fed to continue to cut. All right, a look at some of the single stocks moving at this hour. Meta considering budget cuts as high as 30% for the Metaverse group next year. Sources telling us that cuts that high would most likely include layoffs as early as January. Then there was Salesforce delivering a stronger than expected revenue outlook that was boosted by the company's AI adoption. Shares are only up, though, 0.25%. It's a very different story today for Snowflake. They gave a weak profit margin forecast, and that has been fueling concerns of AI costs. Coming up, consumers are more willing than ever to pay up for products that make chores easier. That includes a washer-dryer combo that does a load of laundry in under 2 hours for $2,000. We're going to discuss today's big take. It's coming up next. Some high interest stories for you this morning. A look at what's making headlines around the world. Bloomberg has learned that Meta is preparing deep cuts to its metaverse ambitions. Mark Zuckerberg is weighing budget reductions of up to 30% for the group behind Horizon Worlds and Quest, if you know what any of those are, because I don't. With layoffs possible as early as January, the push comes as the metaverse continues to burn cash and trail expectations, while Meta shifts towards AI and smart glasses hardware. Unfortunate for them that they changed their name to Meta. Wells Fargo analyst Mike Mayo says big U.S. banks could beat the market again next year, helped by early-stage deregulation and rising earnings. He favors the Goliath banks with strong investment banking exposure. He named Citibank as his top pick. It was followed by Bank of America and J.P. Morgan. As for the mid-caps, he prefers takeover targets like Bank United and Bank of California. Manhattan luxury home sales surged last month, easing fears that Mayor-elect Zohran Mamdani would scare off wealthy residents. Contracts for homes over $4 million jumped 25% from October. Brokers said that there was no sign of a, quote, Mamdani effect. Limited supply, strong bonuses, and rising markets are keeping affluent buyers active and bullish on New York City. Now to our big take, a great read today. Companies like GE and Samsung are rolling out products that can save people time on chores, and consumers are willing to pay up more than ever for it. Bloomberg's consumer team leader, Emily Cohen, joins us again on this story. Emily, let me first say, so there's an anecdote in the story about someone with like a combo washer dryer. I hate combo washer dryers because they never wash and dry all your stuff as much as you want, but this one's like $2,000 and does an amazing job. Is this not just technology getting better? So like, yeah, people want better technology.
Totally. I love this anecdote in the story though, because it starts with Samsung or GE, scrapped plans that they had to make a washer dryer that was more efficient, that would save you money on your electricity bills, and instead decided that from their research, it showed that consumers would actually pay more for this machine if it saved you the step from moving laundry from the washer to the dryer. And apparently on average, people leave their wet laundry in the washing machine for 90 minutes.
Also, I'm assuming that comes from a survey, so it's probably longer. I feel like people aren't going to admit.
Yeah,
because let's be honest, who among us hasn't left something in the washer for like a day until it gets moldy and scary?
Right, 90 minutes actually seemed low to me.
Okay, but part of this stands in such contrast to what we've been hearing, that this is a consumer that isn't going to pay a lot. Big ticket items, a $2,000 washer dryer, they're not going to pay for that. And lo and behold, this story highlights that people are paying for quite expensive stuff.
Yeah, I think this really illustrates, you hear a lot from CEOs on earnings calls that the consumer is choiceful, which I think is a made-up word. What does it actually mean? It means that people are spending, but they're being picky, very discerning about what they're spending on. And I think this story is full of really great examples of what that means in reality.
By the way, I just want to push back. The story doesn't do it, but I feel like some might read the story and get the implication that we're all getting lazier. Like moving things from washer to dryer, we don't want to do that because it's not that we're getting too lazy, right? It's like we're busier than ever.
We're busier than ever.
So if you can have something save a step, then why not do it?
Yeah, we have more demands on our times. We have more distractions too.
Okay, thank you. You're making me, okay, yes, that is very true. Okay, so at the same time you have this, you also have a report, for example, from Dollar General, Five Below, just in the past 12 hours, that did really well, gaining market share from wealthier consumers. How does that square up with a story like this?
Yeah, I mean, I think it does still illustrate this trend that people are thinking more and more about what they're spending money on and is it worth it? And I think that is it worth it question is sort of what's driving wealthier shoppers to a Dollar General or a Five Below. And you see it, like, so where are they pulling back from? Like Kroger is not having such a great time. Target also struggling. The stores that are really executing on what they do, which I think GE fits into that category as a brand in the story. They're executing on what the consumers want. That's paying off.
We also had Nancy Tangler of Loeffler Tangle Investments earlier this week who was talking about Walmart. She was like, one of the reasons I really love this company is what they're doing in technology, and illustrative of that is their move to the NASDAQ away from the New York Stock Exchange. Walmart has been one of these companies really early on saying, hey, here's a use case for AI. We're categorizing things. It's doing work that would have taken hundreds of people to do. Are there any other retailers that are on a sort of Walmart level, or do they stand alone in a clear use case for new technology coming on the map?
Yeah, that's a good question. I mean, everyone's following, right? So Target said that they're also going to be available on ChatGPT, but they weren't first. Walmart was first.
But what does that mean to be available on ChatGPT?
So you can go on ChatGPT
and ask about Target stuff.
Yeah, and you can actually click to buy from ChatGPT now.
Got it.
But yeah, I think Walmart very much is the leader in this, and they made an investment very early on that they were going to challenge Amazon, and I think some people scratched their heads, and this was years ago, and said, Walmart is a brick and mortar retailer. What are they doing? But now they are very much a formidable competitor to Amazon, and it's paying off. You see these wealthier shoppers going to Walmart and paying extra for faster delivery every quarter. That number is going up and up and up. In this story, people are paying for Walmart delivery drivers to unpack their groceries for them. So it's really paying off. And
how many groceries are people getting that they need someone to unpack it for them? Within that, though, it feels like online deliveries just keep eating the world, because there's this narrative that people did it during COVID, and maybe when we get back into the real world, it kind of trails off. I was looking at Costco sales for November, kind of like middle of the road, not great, but what continued to do really well was online deliveries. Emily, is this a share of businesses that's just going to keep growing?
It seems to me.
Yeah.
I think, and it fits the narrative of this piece too, that people are willing to pay for convenience. And a lot of these, like the Walmart delivery that we mentioned in the story, it's not free. It comes at a premium. So this is a space of growth for these companies.
Unless you have an Amex and you get Walmart Plus, which I happen to have, and I do use, so thank you, American Express. Emily, thank you so much for bringing us these excellent stories. That is Bloomberg's Emily Cohn. You can, of course, read the Big Take. NI Big Take Go is where you want to head on your Bloomberg terminal. Still ahead, more to discuss on these markets as the S&P 500 heads for a day of losses after two back-to-back gains. You're watching Bloomberg TV. Just under an hour into your trading day, a check on the equity market this morning. And you are looking at some losses for this equity market, down 1/10%. Pretty even when it comes to the movers to the upside or the downside. What's getting us to the downside? It is Apple, Amazon, Alphabet. Alphabet's had a really good run, but it's kind of backtracked recently. Costco, that's also not doing well. It had some sales figures. To the upside, though, Meta Platforms up 3.5% with that 30% budget cut coming for the Metaverse. Like, guys, you got to change your name if you're Meta and you're cutting your Metaverse. What's up with that? Are they going to become like Meta AI? I don't know. Anyway, let's look at some of the sectors and how they are doing this morning. You can see consumer discretionary and consumer staples. Those are doing really poorly. Interesting, even though we had some earnings from Dollar General that were good. Utilities, industrials, financials, those are to the upside this morning. Overall, a market that's struggling to hang on to any gains after 2 days of gains. Coming up on the show, autonomous trucking company Bot Auto reaching a major milestone. The company's CEO joins us next to explain. This is Bloomberg Open Interest. The Trump administration is reportedly focusing in on robotics for its next set of executive orders. Politico reporting that U.S. Commerce Secretary Howard Lutnick has been meeting with CEOs of the industry. His goal, accelerate the sector's development. Joining us now is Xiaodi Ho, Bot Auto CEO, which is working to bring autonomous trucking out of Houston and onto highways and across the U.S. Xiaodi, really looking forward to getting more and hearing more about what you are doing at Bot Auto. But I'd like to take a step back and talk about the overall robotics industry off the latest reporting of what's happening in the White House. Is there a real need for there to be policy that supports automation, that supports robotics, and moves it forward?
Yes, absolutely. I think the regulation is probably one of the most important cornerstones that government can accelerate for all kinds of robotics, including autonomous driving or humanoid robotics. I mean, I think it's even more important than the funding directly from the government. My best wish is that they can get a best policy, federal level, for autonomous trucking.
Have you had conversations with the White House, Xiaodi? And if so, what sort of feedback have you gotten?
We have been having conversations at the Congress level. I've actually been visiting DC several times and talking to all of the regulators. And I think everyone seems to realize that right now it is a moment for the commercialization of this great technology, and they need to do something in which they are actually doing a lot of things for pushing for the next level of the regulations.
So it's next level of regulations, it's funding as well. But Washington has also been framing this as sort of the next front in the race with China. Is there a real risk that unless that stuff gets done, Xiaodi, that the United States risks dropping behind and falling behind in autonomous logistics?
I think the technology is really on the verge of getting widely commercialized. Therefore, the competition is real. That's on one hand, and the competition is really internationalized. You can see a ton of robo-taxis everywhere in the Middle East, in China, in the US. I do see that there's a competition, and in the past few years, in my opinion, the US has probably the best regulations when it comes to autonomous trucking. And on the other hand, these regulations actually give the first movement for the enablement of the development of the technology here in the US.
Let's talk about your technology, Xiaodi, and what you've been able to achieve, because you've had this milestone. You've had a humanless operation of an 18-wheeler on a Texas highway in Houston. If Matt was here, he'd probably, explain like how cool that is and something about the truck. I mean, these pictures on itself that we're looking for are very, very telling. I mean, look at this. This feels so futuristic. At what point does this go from just proving concept, proving your ability to do this, to large-scale commercialization of this technology, Xiaodi?
Well, if I'm being quantitative, I'll say probably 70% there for full commercialization. The first step you certainly wanted to do is to build the system, but still with a safety driver in it. But after that, we spend a lot of time understanding how the system could possibly be failing. Just like if we're building an aircraft and we want to make sure that even if one engine dies from the aircraft, it can still fly across the Pacific Ocean. So that's really the gist of how we're building this humanless operation. And after all of this validation, we trigger the final driverless run. And we're really doing that multiple times and approaching to the point where if I give myself a timeline, I think next year you will see continuous driver out commercial operation from Bot Auto.
Xiaodi, we have a viewer writing in, because you could see on those images, I mean, what you've kind of done is retrofit a lot of these trucks to include the autonomous technology. Should trucks even look like that anymore? I mean, you don't need a seat, right, if you don't have a human behind the wheel. Are we going to have to change our complete concept of what some of these delivery trucks, these heavy-duty things look like?
I think eventually, yes, but every company has to follow the business logic. And for us, the business logic, which is, by the way, very different from most of the other autonomous driving companies, operation. And we wanted to make sure that this truck, when it hauls freight, it delivers a value to the customer and really minimizes the operating cost. And therefore, having a driver's seat in there, for every now and then, there might be some need, for example, the maneuvers in the yard or something. That is really needed. I don't really see the strong business interest in removing the driver's seat to make it look futuristic.
I was going to say, like, it is the fear of all this autonomous stuff, right, Xiaodi, that it's going to just be completely replacing workers. There have been reports that Amazon wants to lay off like 500,000 of its workforce as it moves more into robotics. What does the world of trucking look like as this technology becomes mainstream?
Okay, first of all, today we don't need to worry. If you're really calculating the overall operating cost of this very cool technology, you'll probably find that most of the autonomous driving companies are actually losing money when operating this thing. So that's why we are saying that we wanted to minimize the operating cost. And by the way, our operating cost is under $2, where compared to human, that's 2.26. However, even with this unit economic edge, that we don't really foresee that we can really mass produce the trucks like tens of thousands, hundreds of thousands of trucks next year. In our best estimate, by 2030, we're going to be 20% of mitigating the driver shortage gap. That's the best that we can do. So I don't really feel that in the near future, any of these big rigs can just say replace human. We're basically supplementing human.
So that's the biggest bottleneck, would you say, Xiaodi? What else kind of prevents this from being mainstream that you and the rest of the industry would need to get over?
We just got to do it very carefully in every step, because safety is really the number one standard for all of the autonomous driving companies. And also the expansion, which has to be done lane by lane. Like right now we're operating between Houston and San Antonio, maybe 2 years later, we go to Atlanta or Florida, Jacksonville. These are the step-by-step operation that we have to gradually expand. Therefore, that's why I'm saying, don't worry too much about replacing human. We're mitigating the driver shortage problem.
Hey, Xiaodi, fascinating stuff. Thank you for joining us this morning. That is Xiaodi He of Bot Auto. A check on your markets this morning, just over an hour into your trading day. Little changed on the S&P 500 as it fights from gains just 1% away from all-time highs. The NASDAQ 100, that continues to sink. A lot of the cloud providers like Snowflake taking a hit this morning with real questions as to the profitability outlay for their AI services. Even Salesforce, which initially was surging in the pre-market session, has now moved to just a little bit higher after their earnings did show more AI adoption. It doesn't help that 10-year yields are moving higher by 2.5 basis points. Will we really get many cuts beyond December? Some of the single stocks that are moving this hour that we want to take a look at. Kroger lowering the top end of its full-year sales forecast down 7.5%. It said that there was intensifying competition as food prices climb. The stock is seeing its worst drop since 2022. Then there's Build-A-Bear delivering a disappointing revenue. They say that tariffs will continue to impact them into the new year. And also another food company, Hormel, reporting mixed quarter results, though they did issue a solid outlook for 2026. Coming up on the show, doubts growing that Kevin Hassett can deliver as Fed chair. We speak to Cayla Seder of State Street, macro multi-asset strategist. That's coming up next. You're watching Bloomberg Open Interest.
On one hand, you have the Fed independence question, with Hassett as, basically tied to the administration. But on the other, does he have the credibility within the committee to drive consensus? And so we don't know that answer. I don't think he has that credibility. I think that's what the bond market is telling you. You have to have the confidence of the committee to drive consensus, and I don't know if he has it.
That was Greg Peters of PGIM Fixed Income. Peters speaking with Bloomberg on concerns about NEC Director Kevin Hassett's potential appointment as Fed chair. Joining us now is Bloomberg economist Stuart Paul. And Stuart, the timeline for announcing the Fed chair keeps getting pushed back, and it feels like Trump isn't being so subtle that it's going to be Kevin Hassett. Is that where we're at? How certain is it at this moment that that's where the Fed sweepstakes lay?
I think it's pretty certain right now. The Trump administration has been very clear in floating a trial balloon 2 weeks ago or last week to see how the market would react. Despite what we just heard from Mr. Peters, on the day that the trial balloon was floated, Kevin Hassett passed the market test with flying colors. Equities rallied, 2 years dropped, 10-year dropped. What more could you ask for from a potential nominee? I think that it's actually smart to push back a potential announcement. It typically takes 2 to 3 months to get somebody through committee and to get a full Senate vote on a new potential Fed chair. So why roll that person out now just to have them sitting as sort of a shadow candidate to take over eventually in May?
Well, one of the things that Greg Peters was also referring to, there's this FT story yesterday that the Treasury went out, sought feedback from both traders, from financial executives about a Kevin Hassett chair. The response, they said that they told the U.S. Treasury that they are concerned that he would cut interest rates aggressively to please President Donald Trump. Is that any of that even priced into markets right now, Stuart?
Look, I'm less concerned with what people say. I'm more concerned with what they do. And even if financial market participants were expressing that concern to the Treasury or to the White House when the White House was asking about potential nominees, it's more important how the market responded when we actually saw Kevin Hassett floated as a trial balloon. And he passed with flying colors.
So what's been more dominant at this moment of kind of leading us to a rate cutting cycle? Has it been this idea of Fed composition or some of the most recent data we've had?
Well, when it comes to rate cuts, at least looking out to next week, the data that we have does suggest a relatively weak labor market. Despite what we saw in today's unemployment insurance claims data, the broad swath of labor market data points to relative weakness. So I think that there's going to be enough of a coalition to get a cut in December. Looking out into 2026, I think that there's just going to be extraordinary division on the committee, despite or regardless of whoever is Fed chair. There's going to be a very hawkish cluster of regional Fed branch bank presidents who are going to become voters next year. And I think that's going to make it difficult for anybody, no matter who it is, who's the next Fed chair come May.
Yeah, and not to mention Bessent saying at the New York Times Deal Book Summit yesterday that they want to change kind of the rules around the regional Fed presidents. Stuart, thank you so much for joining. That is Stuart Paul of Bloomberg Economics. For more on the market reaction, we're now joined by Cayla Seder, State Street macro multi-asset strategist. Cayla, great to see you this morning. And look, to Stuart's point, the trial balloon gets floated, yields come in, stocks rally. Have you been surprised by the market reaction that despite people saying they're worried about Fed independence, it hasn't been as reflected in markets?
Yeah, well, first, thank you for having me. And I think, the thing that really underpins this market right now is inflation expectations. And inflation expectations have been incredibly muted. And so really what that tells me is that the market has a lot of faith that the Fed is going to get inflation under wraps. And so as we see these potential chairman nominees floated, I think it's the inflation expectations in combination with a moderating labor economy where you see the market kind of react this way, where at first they say everything is okay.
How, though, one of the interesting things about what Greg Peters at PGIM was saying, we were listening to that earlier, was that he won't have the credibility to communicate and get policy done, to use those kind of policy tools that you have someone like Powell who typically can do by building consensus and putting that into the market. Is that a real concern that if you have someone like Kevin Hassett, not only is he listening to the president, but just his ability to transmit policy through communication is hampered?
Yeah, this is actually something that we're able to measure is we look at how much disagreement there is at the Fed through this tool we have called MKT Media Stats. And so we have seen disagreement start to increase a little bit, even heading into the end of this year where Powell is still chairman. So, I think that reflects more of what we're seeing on the data. I think regardless of who is going to be leading the Fed next year, because of where the data are right now, there is going to be more disagreement. It just happens to be we have the board on one end and the regional heads being a little bit more hawkish than the doves at the other end.
How much, though? Okay, so we started to price in December a lot. We've seen a market start to rally. How much of that is reading into this belief that we'll get cuts beyond December? And is that not the correct way to read some of the data that we've had coming in?
I think the question for next year, I think that's the right way to think about it because the market is really headstrong around, okay, we're getting this cut next week. I think there's a lot more questions about what is going to come in Q1 and Q2. Now, we have a lot more stimulus coming in, the idea that, Trump saying that we're going to send out $2,000 checks to all voters, things like that. And so that should be stimulative. And so I think we should question how many cuts we'll get next year. Now, what we've seen on the inflation side, at least on our daily measures of inflation, is inflation has started to tick a little higher. So that should push back on cut expectations. But, the market has been relentless in pushing for cuts no matter what. But we think inflation could be a bigger issue next year.
So if this is one of the really big risks of getting a reacceleration where you have inflation, can risk assets still do well? Because we've lived through very recent inflationary times, COVID, where stocks sell off and rebound, even within the inflationary environment.
Yeah, I think they can still do well, and part of that is because where allocation is right now and where allocation really continues to go is towards high quality parts of the market. It brings up questions around concentration, of course, but concentration right now is in these parts of the market that have been able to outperform even regardless of where interest rates are. And so I think that will underpin more of an equity rally into next year, too.
Can I just ask, as you're thinking about your macro outlook, because not only is it a concentration in the equity market and some of these AI names, it feels like it's a concentration in where the growth in this U.S. economy is coming through, too, in AI. So how does that factor in, be it for 2026 or further away? If you do start to get a pullback, maybe not a wholesale reversal, but some of these big companies, the AI hyperscalers, just aren't willing to spend as much.
That could be the case, but I think if they're pulling back, what is the rest of the world doing? If they're pulling back, it's likely that your other investment options aren't doing as well either. And so I think that's why it ends up being this all roads lead back to this high quality part of the market, and that's going to continue into next year.
All right, Cayla, stick with us. We are going to take a quick break first. That's, of course, Cayla Seder of State Street. More ahead on these markets. You can see the NASDAQ 100 underperforming, down 0.2%, just about an hour and 20 minutes into your trading day. You're watching Bloomberg Open Interest. Let's get a check on equity markets this morning because we are struggling to hold on to gains. We have seen an S&P 500 future session that was higher, and we're trying to digest some of the earnings that we've been getting and a weekly jobless claims that was better than expected. Weekly jobless claims under 200,000, and so you get bond yields that move higher, and you get an S&P that falls. You get a NASDAQ that underperforms about 1/3%. Interesting. Small caps actually doing really well. That is a turnaround for them, despite the fact that, again, you have bond yields moving higher. Some of the individual names, we have NVIDIA. That's doing well. Jensen Huang going down to the White House. Just pointing out Warner Brothers Discovery, too. You're getting more bids coming in. Reportedly, Netflix is in the lead for that, and Netflix also is falling because apparently no one wants Netflix to buy them. All right, let's continue the conversation on these overall markets because I'm currently still joined by Cayla Seder, State Street macro multi-asset strategist. So Cayla, you were talking before about this idea of a lot of what we're seeing in the market is more about positioning than necessary risk off. So what does that mean in the setup for 2026 and just how bold up we are and where we go from here?
I think what it means is we're going to be in this environment where on net you still see tech outperform, but it's kind of this intermittent outperformance. Because what we've seen this year and the macroeconomic environment should allow and continue for next year is that you get to this point where we see really large overweights in tech and communications, which when we look at our investor set, so long-term investors, there's 2 overweights, tech and communications. Everything else is pretty much neutral or underweight. And so you get nervousness about concentration risk. You start to see some reversal of your most underweight sectors. As you get closer to benchmark, you start to see selling again and then going back into tech. And so it's this intermittent path upwards, but I think that's going to continue for now, especially because there's so much uncertainty out there. And so if you have uncertainty and you sell your highest concentrated asset right now, it means you're selling your highest quality asset right now.
So it's almost back to this environment, and like this has played out before, where this tends to be like kind of the safe place to be. I mean, I'm kind of loath to say that it's a haven, but what you're kind of describing is every time people get nervous, they go back to tech. Yeah. That they go back, to your point, as you were saying earlier, all roads lead back to there. So if you want to hedge that, where in the world do you turn?
Yeah, I think that's really challenging right now. I think you have a couple of options. One is if you do want to diversify a little bit within sectors, there could be some opportunity within industrials perhaps. We have seen a bit more demand for utilities that's still kind of tied to this AI trade, and I think there's a lot of questions around that. But within industrials, we've seen a lot more demand for aerospace and defense, so that has been somewhat of a hedge. But you're right, it is challenging. So it's not easy these days.
It's really not. And if you were to try to find value somewhere, you could look. A lot of these consumer stocks have been beaten up. Yeah. Discretionary staples, they're among the worst performing sectors of this S&P 500 year to date. It's been confusing. You have Dollar General does really well. Walmart does really well. Some of the other ones have been weak, but retail sales are okay, but sentiment is really poor. How do you make sense of all of that?
It's hard. I would say I haven't been paying as close attention to sentiment reports because what we've learned over the past couple of years is sentiment is one thing, actual action is a whole other thing. And so really looking at, paying attention to retail sales, paying attention to also looking at margins. I think margins are a really big reason why we haven't seen staples do that well, even though you see concerns about the economy, is because their margins are so slim, and it's not totally clear how much the Fed can really decrease interest rates and try to stimulate the economy. So I think that's something to pay attention to that's been keeping investors away from that staples complex.
Yeah, I mean, Hormel Foods today just talking about profitability being strained. Cayla, this has been so fantastic. Thank you for joining. Great great to see you on your trip down from Boston. Please come in anytime you're in New York. That's Cayla Seder of State Street. Okay, coming up on the show tomorrow, Rick Reeder of BlackRock, Joanne Shu of University of Michigan, and Amanda Agati of PNC Asset Management, plus the CEO of Flex will be joining the show. That's it for Bloomberg Open Interest Tech. That's up next.